Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's a very big week for the economy. The Reserve Bank board met on Tuesday, and then yesterday the GDP data for the December quarter was released. The economy grew by 3.4% during the quarter, pretty much in line with expectations. With so much information around this week, I wanted to get a read on how the economy is travelling and what to expect in the months ahead. Diana Massini is the senior economist at ANP Capital. Diana, welcome back to Fear and Greed.
Thanks for having me.
So let's start with the GDP figures yesterday. The economy expanded by 4.2% last year. The pace in December quarter was 3.4%. I must say that 4.2% certainly hides some remarkable volatility. What do you make of the data? Is the economy back on track?
It's been a difficult period to analyse GDP growth since COVID broke out. And the reason for that is because you've seen these zigzag patterns in economic activity. And that's been a result of restrictions being imposed and then being eased on and off, and then on and off again. So the big increase in the December quarter is unlikely to be repeated again because it just reflects the large fall in GDP growth that we had in the September quarter. And if you look through all the details, the states and the territories which had the biggest increase in growth were New South Wales, Victoria and the ACT. And they, of course, were also the ones that had the lockdowns in the September quarter. The other states and territories either had very small falls or pretty much flat gains, or some falls like there were in Western Australia, for example. So going ahead, the GDP growth numbers will be much more stable in 2022, I hope. I hope that we don't go into another lockdown. I mean, we can't rule that out, obviously, but so far so good in terms of how Omicron is tracking. So expect a much smoother ride in growth for this year. We're looking for a pretty decent outcome for GDP, up by about 4.5% in 2022. I mean, that compares to a pre-COVID trend growth rate of somewhere around 2.5%. So we're in a much stronger position than where we were before the pandemic.
And the economy itself is actually larger now than it was pre-pandemic, isn't it?
In terms of the value of GDP growth, yes, it is. There are some moving parts still. For example, if you look at the breakdown for consumers, you can see that consumer services spending is still below its pre-COVID levels, whereas the level of goods spending is well above its pre-COVID trend. And that's because we haven't been able to spend on services like we normally would have on things like travel, on recreation as well. And I think that that will be a much more important driver of GDP growth this year. We'll see some of that services spending be much stronger.
Okay, so in terms of just quickly the December quarter, household spending was strong and that was the main contributor to growth, is that right?
That's right. It contributed about 3.2 percentage points to quarterly GDP growth, as well as a very big increase in inventories. There was a rebuild from businesses. We had a large fall in the September quarter that was related to the lockdowns again, where a lot of businesses were drawing down on some of those inventories.
Okay, so if we move into 2022, how do you think this quarter is tracking, or this year is tracking?
The consumer spending data that we have from bank credit card data, now the ABS is also releasing this monthly household spending indicator, which has actually been quite useful in terms of its tracking for consumer spending. It did overestimate the December quarter growth, but nevertheless, I think it's still a pretty good indicator, and it's good to have a more monthly read on a broader set of consumer spending data that's not just the retail sector. So I think the consumer still remains in a very solid position for the March quarter. There's a big level of accumulated savings for consumers that can be drawn down on. In terms of the construction sector, we expect more falls in residential construction in the March quarter because some of that high demand for building activity that was related to home builder last year is now starting to wind back. Business investment growth should be positive and solid. The last few years have seen pretty moderate levels of business investment, but I think we're in for a period of much stronger business investment environment, and that's what the CapEx survey is indicating to us in terms of its forward-looking components. It's saying that business investment growth should be pretty decent over the next few years. Government sector will probably make smaller contributions to GDP. I thought it was interesting that in the December quarter, government spending was down by about 0.3%. And that's the first time we've actually seen a fall in government spending since September 2017. So it's made a very large contribution to spending and GDP outcomes over the last few years.
Stay with me, Diana. We'll be back in a minute. My guest this morning is Diana Messina, Senior Economist at AMP Capital. Okay, now the day before the Reserve Bank Board met and Governor Philip Lowe put his usual statement out, the bank certainly, if you just take away Ukraine for a moment, is certainly pretty happy with how the domestic economy is running.
Well, we've heard a lot from the RBA recently. They released their statement of monetary policy. There were some speeches as well and a testimony before Parliament. So if we just compare how the RBA saw things in early February, the only major thing that's changed is the Russia-Ukraine war, and we also had the wages update. The wages print for the December quarter was virtually in line with the RBA's forecast, and they've been looking for wages growth to slowly increase, and wages growth is running at about 2.3% over the year, which is in line with their forecasts. So the only major change for them is Russia-Ukraine, and that is unlikely to have a big negative impact on Australian GDP growth. It will have other impacts through the exchange rate channel, through financial market sentiment, and then potentially the wealth effect from negative impact to stocks and the impact to people's portfolios from that. Just a general level of consumer confidence as well might be negatively hit. But Australia does such little trade with Russia. It's only worth about 0.2% of our exports, that it's unlikely to see a big change in our national trade balance. And of course, the inflation impact is the main one that the RBA would be looking for from the Russia-Ukraine tensions, because how high commodity prices have been over recent weeks, prices for things like natural gas, for oil, for metals, and even some agricultural commodities have gone up quite significantly because those two regions or countries are such major suppliers of some of these commodities.
Okay, just on that, shifting to the floods that we've seen in Queensland and then along the coast of New South Wales, what sort of economic effect will they have? Could we see a spike in food prices, for example?
Normally, when you see a catastrophe like flooding, you do tend to see a short-term spike in fresh fruit and vegetable prices. So I do think that food inflation will be a strong contributor to March quarter inflation data, mainly on the headline side. So probably not too much of it will flow through into the core reading. So again, we're seeing this higher pressure for inflation over the next 6 months, both from the Russia-Ukraine conflict and then also from the floods. The other impact of the floods is, of course, the short-term negative hit to GDP via production and loss of consumer spending, loss of business investment that's related to that. But then after that initial downturn, you start to see a pickup when you get the rebuild coming through. So that could take maybe 0.1 or 0.3 percentage points off GDP growth, but it doesn't change the overall story.
Okay, we've spoken about Ukraine and the floods. Is the biggest risk to the outlook still a new variant of coronavirus?
I think the biggest risk is the central bank themselves.
Right.
We normally tend to see crises or big downturns in economies as a result of a central bank policy changes, usually large policy changes. We haven't had a rate rise in Australia for more than a decade, and as consumers have become accustomed to having low interest rates, a lot of consumers have taken out large mortgages as a result. Level of household debt to income remains around its record highs. When you start to see rate hikes come through, it may be a shock to the system for some people. And we are already seeing the fixed rates for mortgages rising. But when you start to see more rate hikes come through, it will flow through to variable rates and then even more to fixed rates. So there is a risk around the consumer outlook when interest rates start to rise. Now, we're not expecting rate hikes or the interest rate to go suddenly to 4 or 5%. We're at 0.1% at the moment. But even a few interest rate hikes might still lead to some negative impacts to consumer spending. I think for the next year, the consumer outlook still looks pretty good because our prediction of rate hikes will be that they will be quite slow, and the cash rate will only end this year at 0.5%, which is not very high. But the more rate hikes you get, the riskier the consumer situation becomes.
Okay, and your forecast is for an August rate hike?
At this stage, we still think that the RBA wants to see another wages print and some more confirmation that consumer price inflation is tracking in the direction that they've been forecasting. So higher headline and higher underlying inflation. And we think that we will see these confirmations when you get the next set of inflation data. The RBA doesn't want to rush into rate hikes because they've been undershooting their target of 2 to 3% since 2014. So they want to be sure that it's the right time to raise interest rates because there are still COVID-related supply chain issues going on, which will pass through. You know, some of these supply chain problems look like, well, they are starting to ease based on some of our leading inflation indicators, and they're not likely to be impacting the inflation data as much in 6 months' time. So there is genuine reason to think that inflation will start to come back down towards the end of this year and into early 2023. It's just that you'll see other inflationary pressures come through, like wages growth, because the economy is in such a strong shape. So the RBA just needs the confirmation that this is the right time to hike rates. I still think that the risk for interest rates is with an earlier rate hike. So we do have an expectation that the first hike will be in August, but we could see it come in June if the next set of wages and inflation data gets the RBA too worried that we're in for an inflation shock like we're seeing in the US at the moment.
So what happens if they don't lift rates and we get the inflation shock? What's that mean for we normal people in the street?
It means that in the medium term, the economy may be in a position where it overheats, and that happens because the level of monetary settings and the fiscal settings that we've had over the past 2 years are too stimulatory for the economy. So you can start to see higher inflation creep up everywhere and become unsustainable. And unsustainable inflation means rates that are running at 4 or 5% annual growth in prices, much like you're seeing in parts of Europe and the US, where they have very high headline inflation. Their core readings are closer to 4 or 5%. Some big increases lately for them from energy costs, and Australia has been quite shielded from these increases in energy prices. And they've also seen big increases in rents and housing, and we haven't had that same situation here. But unsustainable inflation is negative for consumer spending because it eats into purchasing power, unless you're getting a 4 or 5% wage rise. But then you get into the situation where you get into a wage price inflation spiral and everything starts getting out of control, and then you risk these very high price rises continuing for a long time. And that's just unsustainable for an economy.
Diana, thank you for talking to Fear and Greed.
Thank you so much for having me.
That was Diana Messina, Senior Economist at AMP Capital. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.